Welcome back to Forex in 9 minutes, where I give you the sauce in 9 minutes or less. If you want to learn about trending and ranging market conditions, this video is for you. I'll explain the differences between uptrends, downtrends, ranges, and consolidations. So watch till the end, and if you find value in this type of content, consider giving a like, subscribing, and turning on your notifications so you know when the next episode is released. Forex in 9 minutes. Let's go. The market moves in three general ways: an uptrend, downtrend, or sideways or ranging condition. Within an uptrend, we get this definition by price making a series of higher lows and subsequent higher highs. In order for this higher low to be validated, it needs to create a higher high. Higher highs should also lead to higher lows in order to get their validation. Within an uptrend, the higher highs are considered a weak level of resistance, and the higher lows are a strong level of support. To maintain an uptrend, price has to make subsequent higher highs, but price can also make an equal high, and the uptrend has not been violated. The uptrend is not violated until a valid low is broken. So in a circumstance where this higher low failed to make a higher high but rather made an equal high, it would not be a valid low point. This last low point here would be the last valid low point, so price would need to break this low to be considered a change of the trend. As long as price is within this range, the trend is continuing. Now the same thing is on the inverse for a downtrend. You have a series of lower highs, which is the key, which make lower lows. And like the uptrend, the lower high has to create a lower low to be validated. In a downtrend, the lower highs are a strong level of resistance, and the lower lows are a weak level of support because they're expected to be broken going along with the trend. Now for uptrend and downtrend, you can remember the important side is the side that the traditional trend line is drawn. So we're connecting the higher lows on the underside of an uptrend, and then we're connecting the lower highs on the top side of a downtrend. Now the third type of market condition is the range. This is when price makes equal highs and equal lows, or relatively equal highs and relatively equal lows. Price generally will move between two well-defined areas of support and resistance without breaking out. Usually when this occurs, the market maker is accumulating orders, and you will generally have an explosive breakout because price is like a pressure cooker. Price is being confined to a small area and then it must release. So the range condition exists until price makes a higher high and has a bullish breaker structure, or price makes a lower low and has a bearish breaker structure. Not to be confused with the range is the consolidation. Range and consolidation, those words are used interchangeably to describe a ranging condition, but they're actually a little different. A range is not a consolidation, but a consolidation is a form of a range. With the consolidation, it is a converging range because price is consolidating, getting smaller and smaller and converging between two defined areas of support and resistance into a smaller trading range. So price is in effect making lower highs and higher lows as the trading range gets smaller. Another variation of a ranging or sideways market is an expanding range. Now with the expanding range, price is making higher highs and lower lows in between an area of support and resistance as price makes ever increasing trading range. Both of these patterns, just like the regular range, will eventually have a breakout. The expanding range can be difficult to trade because every time it makes a move, you're getting a break of structure, and we usually use break of structure to indicate which way the market has decided to go. So this will offer a lot of fake outs. So be careful when you come across this type of pattern. When approached with a range, it is best to wait for the range to have a breakout and a retest and form some type of market structure to indicate which way that the market is going. In the next episode, I'll explain how to identify the market structure trading range. So make sure to tune into the next episode of Forex in 9 minutes.